There are days when the most profitable trade I ever made was doing absolutely nothing. I want you to sit with that for a second, because if you're like most traders, that sentence probably makes you uncomfortable. We're taught conditioned, really, to believe that activity equals progress. Screens glowing, charts moving, orders firing. If you're not trading, you must be missing something. And yet, Jesse Livermore built his legacy, not on constant action, but on disciplined restraint. I'm speaking to you now not as a guru on a pedestal, but as someone who has stared at the screen with itchy fingers, convincing myself that this setup was good enough. I've felt the anxiety of watching price move without me. I've chased candles out of boredom. I've overtraded just to feel relevant. And every time, the market charged me tuition. This documentary isn't about entries. It's not about indicators. It's about a skill no one teaches you when not to trade. The decision that doesn't feel like a decision at all. Jesse Livermore once said that money is made by sitting, not trading. And yet most traders hear that quote, nod their head, and go right back to overtrading the next morning. Why? Because not trading feels like weakness, feels like fear. It feels like you're falling behind. But Livermore understood something most never do. The market doesn't pay you for effort, it pays you for timing. And timing doesn't come from constant participation, it comes from selective presence. Think about this. Livermore lived in a time without algorithmic noise, without social media, without 1,000 opinions screaming at him every minute. And still, his greatest challenge wasn't finding trades, it was avoiding bad ones. If he struggled with that in a quieter market, what chance do modern traders have without learning this skill consciously? Here's the uncomfortable truth I want to put on the table right now. Most of your losses are not because you don't know how to trade, they're because you don't know when to stop. We glorify the hustle trader, the always in the market personality, the one who never misses a move. But Livermore didn't admire that trader, he pitied him. Because the market always outlasts impatience. This documentary is for the trader who feels exhausted, for the one who keeps trading but feels stuck, for the one who secretly wonders, why do my best days happen when I trade less? And if that question hits a nerve, good, because awareness is the first crack in the illusion. Be honest with yourself. When was the last time you took a loss that happened simply because you felt like you had to trade? Comment below. I read those stories more closely than you think. As we move forward, I want you to understand the lens we're using. This isn't about avoiding the market out of fear. Livermore was not a coward. He was aggressive, but only when conditions demanded aggression. The rest of the time, he waited, watched, observed, protected his capital like a general protects his army before a decisive battle. And here's the paradox that sets the stage for everything that follows. The discipline to not trade is harder than the discipline to trade well, because trading gives you dopamine. It gives you a sense of control. Not trading forces you to sit with uncertainty, with ego, with boredom, with the fear of missing out. In the next section, we're going to step directly into that inner conflict, the psychological war between patience and participation. The war Livermore fought daily, the same one you're fighting every time the market opens. This is where the story really begins. The hardest battle in trading is never against the market. It's against the voice in your own head that says, you should be in this trade. Let me take you inside that moment because every trader knows it. You're sitting there. The market is open. Candles are printing. Twitter is buzzing. Someone just posted a screenshot of a massive win, and suddenly silence feels dangerous. Doing nothing feels wrong. This is the paradox Jesse Livermore wrestled with his entire career. The market rewards patience, but the human mind is wired for action. We are not built to wait. We are built to respond, to fix, to interfere, and the market exploits that weakness mercilessly. It dangles movement in front of you like a shiny object, knowing that most traders would rather lose money than feel irrelevant. I've been there convincing myself that I'm staying sharp by trading mediocre setups, telling myself that experience only comes from participation. But Livermore learned, often painfully, that participation without edge is self-destruction disguised as discipline. Here's the inner conflict no one prepares you for. You can be right about the market and still lose money because your timing is wrong. And you can be wrong about the market and still protect your capital because you chose not to play. Livermore understood that the market spends most of its time doing absolutely nothing of value. Chop, noise. False moves designed to extract emotional energy from impatient traders. The real money is made in short, violent bursts, but only by those who had the courage to wait through the boredom. And boredom is dangerous. Boredom whispers lies. It tells you that this time is different, that maybe you're overthinking, that small trades don't hurt. But every trader who was blown in the count didn't do it in one dramatic moment. They did it trade by trade, during periods when the market offered no real opportunity, only temptation. This is where the paradox deepens. The more intelligent you are, the harder this becomes. Smart traders over-rationalize bad trades. They can build a story around any chart. They mistake analysis for edge. Livermore warned against this. He believed that the market doesn't reward cleverness, it rewards alignment. Alignment with trend, alignment with timing, alignment with conditions. And when alignment isn't there, the correct move is not patience inside the market, but patience outside it. But here's what really makes this conflict brutal. Not trading feels like failure. No one applauds restraint. There's no screenshot for discipline. No dopamine hit for sitting on your hands. You can't post, "I didn't trade today," and expect validation. So traders subconsciously seek action just to feel alive. Livermore faced this same pressure. Even as one of the most famous speculators in history, he felt the urge to be involved, to justify his reputation, to prove he still had it. And every time he gave in too early, the market punished him not out of cruelty, but indifference. The market doesn't care who you are. It doesn't care how badly you want it. It only cares whether conditions are right. Have you ever entered a trade knowing deep down that it wasn't really there, but you did it anyway? What were you trying to satisfy in that moment? Comment below. This inner conflict is the silent killer of trading careers. Not lack of knowledge, not bad strategies, but the inability to sit with uncertainty without acting on it. And here's the uncomfortable realization Livermore eventually came to. Most traders aren't addicted to profits. They're addicted to participation. Participation gives them identity. It gives them a sense of control in an uncontrollable environment. But the market punishes control-seeking behavior. It rewards humility. In the next section, we're going to expose the psychological trap at the core of this conflict, the trap that turns intelligent, hard-working traders into their own worst enemy. Because once you see it clearly, you can't unsee it. The market doesn't trap traders with complexity, it traps them with hope. Hope is subtle, dangerous, it feels positive, even rational. But Jesse Livermore learned the hard way that hope has no place in disciplined speculation. And the psychological trap most traders fall into, the one that keeps them trading when they shouldn't, is the belief that being right eventually is the same as being right now. Let me slow this down, because this is where careers quietly bleed out. Most traders don't lose money because they misunderstand charts. They lose money because they misunderstand themselves. They confuse anticipation with preparation. They confuse opinions with timing. And worst of all, they confuse market movement with market opportunity. Livermore saw this clearly. He observed that traders want to predict, not respond. They want to feel smart. They want to catch tops and bottoms. And when the market doesn't immediately validate them, they don't step back, they double down emotionally. This is the trap. The moment you feel the need to justify a trade after you've entered it, you're no longer trading the market, you're defending your ego. I've watched this happen in myself. Maybe you have too. You enter a trade that doesn't quite meet your rules, but you tell yourself you'll manage it actively. Price moves against you slightly, and instead of accepting the information, you start negotiating with reality. You zoom into lower time frames. You search for confirmation. You turn a weak idea into a personal mission. Livermore warned against this exact behavior. He believed that the market speaks clearly, but only to those who aren't already emotionally invested in an outcome. Here's the core psychological problem. Most traders trade to relieve emotional discomfort, not to exploit statistical edge. Discomfort comes from waiting, from uncertainty, from watching others win. So traders trade not because the conditions are right, but because inaction feels intolerable. And the market knows this. That's why it moves just enough to lure you in. That's why false breakouts exist. That's why chop exists. These aren't accidents. They are natural consequences of mass psychology designed to punish impatience and reward discipline. Livermore believed that the market's primary function is not to distribute wealth, but to transfer it from the impatient to the patient. And patience in this context doesn't mean waiting in bad trades. It means waiting out of bad environments. But here's where the trap tightens. The more time and effort you invest into trading, the harder it becomes to step away. You feel like you should be trading. You've studied, you've prepared, you've sacrificed. So when conditions are wrong, instead of standing down, you lower your standards. You tell yourself, a small trade won't hurt. Livermore would have called that a fatal compromise. He believed that rules are only rules if they applied during emotional pressure. Otherwise, they're just suggestions. And the rule of not trading during unclear conditions was one of his most expensive lessons, because every unnecessary trade does more than damage your account. It damages your confidence. It teaches your nervous system to associate trading with stress. Over time, you stop trusting yourself, not because you lack skill, but because you keep violating your own boundaries. Be real with yourself. What emotion usually pushes you into trades you know you shouldn't take? Boredom, fear of missing out, the need to recover losses? Comment below. Livermore understood that the market is always open, but opportunity is not. And the trader who cannot distinguish between the two will slowly self-destruct while believing they are putting in the work. This psychological trap is invisible until it's too late. Because from the inside, it feels like discipline, like persistence, like ambition. But from the outside, from Livermore's perspective, it looks like impatience wearing a mask. In the next section, we're going to step directly into Jesse Livermore's mindset and see how he framed this problem, how he learned to recognize when the market was not offering opportunity, and why stepping aside was, for him, an act of strength, not fear. Jesse Livermore didn't ask, "Can I trade today?" He asked, "Does the market deserve my capital today?" That single shift in perspective changes everything. Livermore viewed the market not as a playground, but as a battlefield. Capital was ammunition. Every trade was a deployment of resources. And just like a general doesn't send troops into meaningless skirmishes, Livermore refused to engage when conditions were unclear. This is where his mindset separates sharply from the modern retail trader. Most traders wake up asking, "What can I trade today?" Livermore woke up asking, "Is today worth trading at all?" He believed the market moved in phases: accumulation, markup, distribution, and decline, and that most of the time, price was simply drifting between these phases. Those in-between periods were dangerous, not because the market was unpredictable, but because it was deceptive. It offered motion without meaning. Livermore called this the waiting game, and he hated it not because it was boring, but because it required supreme self-control. He once admitted that some of his biggest losses came not from bad analysis, but from entering too early before the market had declared its intention. He learned, through pain, that confirmation was more valuable than prediction. Let me put that into modern terms. Livermore didn't care about being first. He cared about being right with size. If the market hadn't proven itself through structure, volume, and follow-through, he stayed out, no matter how tempting the setup looked, no matter how strong his opinion felt. Opinion, to him, was cheap. Price action was expensive. And here's the part most traders miss. Livermore believed that not trading was an active decision, not passive avoidance. He didn't sit out because he was uncertain. He waited because he was certain the market hadn't earned his participation. That distinction matters. He wrote that there are times when a trader must do nothing, and that doing nothing is the hardest thing of all. Because while you're doing nothing, the market is constantly trying to provoke you. Fake moves, sudden spikes, headlines, all designed to make you abandon discipline. Livermore understood that clarity only comes after the market reveals its hand. And the trader who jumps in before that moment isn't bold, they're impatient. This is why he emphasized sitting through noise. He would watch markets for days, sometimes weeks, without making a single trade. Not because he lacked ideas, but because none of them met his standards. Standards were everything. Once you compromise your standards, Livermore believed, you start trading your emotions instead of your system. And once that happens, the market owns you. If you're honest, how often do you lower your standards just so you can be in a trade? Think about it, then comment below. Livermore also knew that restraint preserved more than capital, it preserved clarity. When you're overtrading, your mind is cluttered. Every tick matters. Every move feels personal. But when you step back, patterns emerge. Context returns. He used inactivity as a strategic tool. By staying out during unclear conditions, he kept his emotional capital intact. So when the market finally aligned, when the trend was undeniable, he could act decisively, without hesitation, without fear. This is the irony. The traders who trade the least during bad conditions are the ones who trade most aggressively during good ones, because they're rested, focused, certain. In the next section, I want to bring this philosophy to life with a real-world story, a moment that shows how ignoring this principle cost Livermore dearly and how respecting it later made him fortunes. This is where theory meets consequence. One of Jesse Livermore's most painful lessons didn't come from being wrong about the market. It came from being early when the market wasn't ready. Let me tell you a story that perfectly captures why, when not to trade, mattered so much to him. Early in his career, Livermore correctly identified a major market direction. His analysis was sound, the fundamentals aligned, the technical supported his view. By most standards, he was right, but the market didn't move the way he expected, at least not yet. And that delay destroyed him. He entered positions before the market confirmed his thesis. Price chopped, volatility shook him, small losses piled up, margin pressure mounted. Eventually, he was forced out emotionally exhausted and financially wounded. Then the market moved, exactly as he had predicted, without him. That experience haunted Livermore. Not because he missed a profit, but because it exposed a brutal truth. Being right too early is indistinguishable from being wrong. I want you to really absorb that. From the market's perspective, timing is truth, not ideas, not intelligence, not conviction. And Livermore learned that the market doesn't reward foresight, it rewards synchronization. He later reflected that if he had simply waited, if he had done nothing, he would have preserved both his capital and his confidence. Instead, his need to act turned a correct insight into a costly mistake. Modern traders repeat this same error every day. They see a setup forming and jump in before confirmation. They anticipate breakouts instead of waiting for acceptance. They buy support before it holds. They sell resistance before it proves itself. Why? Because waiting feels like missing out. Livermore eventually reframed this completely. He wanted the market to prove it was ready through decisive movement, expanding volume, and follow through. Only then would he act. And when he did act, he acted big. But what made this story so powerful is not just the lesson, it's the emotional cost. Livermore described the frustration of watching the market move without him, knowing he had been right but had violated his own discipline. That pain etched the rule into his psyche. No trade is better than a forced trade. Have you ever been right about the direction, but still lost money because you entered too early? Share that moment in the comments. This experience changed how Livermore viewed inactivity. He no longer saw it as wasted time. He saw it as insurance, insurance against emotional decisions, insurance against premature commitment. He began to respect the market's timing more than his own intelligence, and that humility transformed his trading. Because once he stopped trying to predict when something would happen, he could focus entirely on recognizing when it was already happening. In the next section, we're going to descend into the emotional low point. Every trader faces the moment when restraint feels unbearable, and the temptation to break rules becomes overwhelming. This is where most traders fail. There comes a moment in every trader's journey when silence becomes louder than losses. This is the moment Livermore knew intimately. The moment when the market offers nothing but your emotions demand something. No clear trend, no clean setup, just endless movement designed to test your resolve. This is the emotional low point. You're not losing massively. You're not winning either. You're slowly bleeding small losses, commissions, mental fatigue, and worst of all, self-doubt creeps in. You start questioning your edge, your discipline, your identity as a trader. Livermore described this phase as more dangerous than outright failure, because failure forces reflection. This phase seduces you into survival mode. You tell yourself, I just need one good trade. You loosen your rules just a little. You start reacting instead of waiting. And emotionally, this is exhausting. I've been there staring at charts, feeling disconnected from the market, yet unable to walk away. Because walking away feels like admitting defeat. It feels like you're not cut out for this. Livermore faced this same internal collapse during his worst drawdowns. He wasn't ignorant of what he should do. He was emotionally compromised from doing too much for too long. That's the turning point. The realization that overtrading isn't a strategy problem, it's an emotional regulation problem. Livermore eventually recognized that his losses during these periods weren't random. They followed a pattern: fatigue, impatience, forced trades, nigh regret. So he made a brutal decision, one that feels counterintuitive to most traders. He stopped trading entirely during unclear phases. Not scaled down, not reduced size, stopped. This wasn't fear, it was self-preservation. By stepping away, he allowed his nervous system to reset. He regained objectivity. He stopped seeing every price movement as an opportunity or threat, and something interesting happened. Clarity returned. When he came back, he could see what had been invisible before, that the market had never offered real opportunity during that period. Only noise. Have you ever felt mentally drained from trading even when your losses weren't huge? What did you do in that moment? This emotional low point is where traders either evolve or self-destruct. Those who push through without restraint burn out. They lose confidence. They start revenge trading. Eventually, they associate trading with pain. But Livermore chose a different path. He accepted that stepping away was not weakness, it was mastery. In the next section, we'll uncover the exact rule that emerged from this turning point, the principle that became one of Livermore's most powerful weapons. This rule is simple, but it's unforgiving.